Good afternoon, everybody. It's great to be here, presenting to all of you. My name's Dan. Oops. My name's Dan, and our team name is the Prestigious Advisors. We would just like to note that we didn't choose this name. Our second years made this selection for us. We view it as more aspirational than literal, maybe, but we'll do our best to live up to it. Here's our team. So we have Lauren, myself, Ali, Arturo, Pablo, and Joe, and all of us will be presenting today. So you'll hear from everybody. So quick rundown of what we'll be covering. We have a brief executive summary. We're going to have a look at the macro environment, and particularly how that affects the fund. We're going to look at some selling and some investment opportunities. We're going to make some specific recommendations and see how those play out, and then we'll have a brief conclusion. So a brief overview of the fund. We, as you know, we're about 5 billion gross asset value and about just over 2.5 in net asset value. So our leverage ratio is about 46%. The fund mandate is 55% leverage ratio, so that's something we need to keep in mind throughout. In terms of our go-forward strategy, really, we're trying to deal with the macroeconomic environment in particular, and we're going to look at how that affects our short-term and our long-term fund sector allocations. We're then also going to be looking at the write-downs. We've had some write-downs already, and we're expecting some more, and we're looking at how to handle those, and in particular, with the tight capital markets at the moment, how that affects both our leverage and our liquidity. We'll then be going through some opportunities. We've got 6 assets that are available for sale, 2 potential investment opportunities, and again, we'll be focusing on these in terms of how they affect both our liquidity and our leverage in particular. I'll just pass over to Ali to go through the state of the market.
So now I'm going to talk about the macroeconomic environment. So let's talk about the key driver of the inflation. So we have a consumer price index, which is currently 3.7% and is high. And we have an unemployment rate, which is 3.9%, which is low. All this information is important for the Fed to make some decisions. So basically this year, the Fed increased the interest rate by 1%. And currently they put the pause on it. And the current interest rate is around like 5.5%, and we predict the interest rate should be steady or maybe slightly higher. It always depends to the inflation. So why do we care about the inflation or interest rate in the markets? So we could have a possible chance of the recession risk or increased credit risk, and also some of the property value could go down. And we could see the growing bid and ask spread. So now I'm going to let the Pablo talk.
Thank you, Ali. So now going through the fund sector allocations that are mainly driven by the macroeconomic environment that Ali was telling us. So in residential, we're facing refinance risk in our current assets. That's why our near-term strategy is to decrease the allocation, but to maintain in the long term. If we're talking about industrial and storage, so as they are correlated to the economic cycle, our current position is to maintain in the near term, but to increase the allocation in the long term because we are expecting supply constraints. For office, we are maintaining the position because we are seeing some opportunistic potential for value creation there. In retail, our recommendation is to decrease the allocation in both near-term and long-term due to high interest rates that convey low in sales. And finally, data centers, we see the opposite. So there is an expected exponential demand growth. So we're increasing the allocation both in the near and the long term. A quick fund overview. So with the metrics on the left side of the screen as of the third quarter of 2023, we have to take into consideration as the near term through the fourth quarter of 2024, 2 main things. One is the liquidity needs that I'm going to dive deeper in the next slide, and leverage. So as Dan was explaining, we have a mandate of 55% maximum leverage. And also we're facing 10 to 15 expected asset value write-downs that are going to affect these metrics really high. So as the near-term liquidity needs, we have 2 main components. One, the redemption request. They are as the 4.5% of our net asset value, or 117 million. We have to take into consideration that our fund is required to fulfill up to the 2.5% of the quarter-end net asset value. So our management plan is to honor that 2.5% and not go farther. And also, our management plan consists in funding with cash in hand and not recurring to debt. And the second component is the debt maturities. They add up to $162 million through the first and the second quarter of 2024. And we are at risk for a deficit in refinance proceeds. So our management plan is to fund them with a combination of cash, LOC draws, refinancing proceeds, or asset sales. Now I'm going to pass it to Lauren.
Thank you, Pablo. So in addition to our near-term liquidity needs, we also decided to take an in-depth analysis into our asset valuations, specifically as it relates to any potential future write-down in asset values. Currently, market research suggests that there could be an additional 5 to 15% decline in asset values over the next 2 quarters, depending on the asset class. And based off that initial piece of market information, we came up with 2 main scenarios, the first of which is our base case scenario. And as you can see here, our base case assumed a straight 10% decline in asset values across all the fund's asset classes. However, we all know that not all asset classes are created equal. So we wanted to take a deeper dive into thinking about how the fund should be thinking about how they're writing down their assets over the next 2 quarters. The first thing that we looked at was the broker opinion of value discount, and particularly how those values compared to the fund's carrying values at the end of the 3rd quarter of 2023. And you can see those discounts in that column there. The only issue with the broker opinion of values is that they're very asset specific, and we didn't want to take a straight, use those across all of the fund's assets within each sector, because again, those are very asset specific. So we took it one step further and looked into the near and long-term fundamentals, again, into each of the asset classes that the fund holds. And so based off those 2 pieces of market data, we've come up with our own recommended adjusted discounts per asset class. And as you can see, and everyone is familiar, office is the leader in write-downs, historically, just given the market. So in our base case scenario, again, we're assuming that office is being written down 20%. And our downside scenario, again, this is kind of what we view as a sensitized scenario. This just assumes a cumulative 15% decline in asset values over the next 2 quarters. After going through that analysis, we wanted to see how do these asset values, write-downs impact the fund's balance sheet and mainly their key metrics. This snapshot assumes the fund operates as is, not selling any assets or investing in any any investment opportunities. And what we primarily wanted to see is what does that do to the fund's leverage ratio and their liquidity position. And this is our base case scenario, so assuming a 10% cumulative write-down in asset values, leverage creeps up 600 basis points to 52%. But the primary thing that's impacted pretty considerably is the fund's liquidity position, which has decreased by almost 56% compared to the end of 3rd quarter of 2023. In a sensitized scenario, again, what we really wanted to focus on was if the fund operates as is, what does this do to their key metrics? As you can see, assuming a 15% decline in asset values, the fund's actually at risk of potentially breaching their mandated 55% leverage ratio because there's no inflow of cash flow. So now I'm going to pass it off to Arturo, who's going to talk about how we're going to manage that.
Thanks, Lauren. Speaking about ratio, we decided to have an approach where we evaluated all the risk factors that incur into our fund. As it was mentioned before, we are considered a recessionary environment, so this is affecting our value in our properties, and we identify that there's one external risk factor, which is this write-down. Even though it does not affect our cash impact, we are being compromised in our leverage because a 15% markdown, as you can see on the right side of the slide, is getting our leverage position above the mandated 55%. So that is something to consider for the following slides. And also, we have 2 obligations, equity redemptions and maturing debts that are coming up in the next year. They're going to impact both our cash and our leverage because this is going to be a cash outflow. And then finally, the 2 opportunities that are presented to us, the credit and the equity opportunity, we need to evaluate them for the risk they pose to the firm. In the case of the credit opportunity, it does not affect our leverage, so that is an advantage, but they both impact our cash. And given all these risk factors, we identify that the value write-downs are the biggest risk to our firm because of the leverage issue, and it's just for 2 points. The first one is this is something that we are not controlling. This is something that is dictated by the market. And 2, it is also only countered by a cash inflow that could require selling some assets. As we mentioned before, a 15% markdown, as you can see on the right hand of the slide, is going to increase our leverage above the 55% required. So given these 6 selling opportunities, we recommend selling 2 portfolio properties. The first one being the Shops at Soho. This retail is right now with strong leasing fundamentals, the market is at historic highs, so it's going to be an attractive investment for a third party. This is why we recommend selling first this. And secondly, we are recommending selling the luxury high-rise property because first we see a 50% oversupply in the stock market under construction. And also we have a debt coming up in 2024. This is going to impact both our leverage and our cash liquidity. And this is why we're recommending selling these two properties. Now Joe will talk more.
Great. Thanks, Arturo. I'm going to come over to this side. So first we have the equity opportunity, and then we'll go through the debt opportunity. So the equity opportunity, the purchase price is $50 million. Let's see. Also, importantly, the debt is $30 million, so that would be a loan-to-value of 60%, which would increase our portfolio-wide leverage. The hold period is between 3 and 5 years. We plugged that in the model to come up with the scenario analysis. So what you're looking at on the left column is 3-year hold, on the right column a 5-year hold. Scenario 1 is low rent growth, scenario 2 is high rent growth, scenario 3 is middle of the road, 3% annual rent growth. And so what you can see is the 3-year hold, because we're acquiring the property with 50% vacancy, we're looking for a lot of NOI growth. And so what you see is that the levered does, or I guess you're seeing a lot of NOI growth. So the 3-year does better than the 5-year, and then the levered does better than the unlevered. And so we took the 11.87% IRR as kind of our base case. And then down here in the sensitivity analysis, we sensitized that. And in this environment, we didn't think that 0 to 1% rent growth was out of the question. So then if we saw, call it 75 basis points increase in cap rates, we'd be losing money in this investment. So we were a little bit worried about that. Also, the leverage in this one would increase our firm's overall leverage. So now we have the credit analysis. The credit opportunity is a $42 million mezz loan. The total loan is $168 million. Similar to the equity opportunity, it's a 3 to 5 year hold, and the expected yield is 12%. We didn't get a lot of information on this one, but we got the debt yield, and if you look at the mezz loan piece, then you can apply the NOI. So we got $15 million, and we implied a value of about $240 million. We also assumed that between the senior and the mezz, the blended rate would be about 7.5%. And so looking at the sensitivity analysis down here, we said, how far would NOI have to drop before the borrower couldn't pay back the debt? And we figured that NOI would have to drop 15% before they wouldn't be able to make their debt service. So we felt pretty comfortable there. And then looking at the sensitivity table down here, so we're up here on the left with about $70 million in equity. Cap rates would have to gap out to 9%, or NOI would have to decrease by 30% before we're impaired. So we like that. And going to the last slide here. So at a high level, the equity opportunity has, even when it's levered, has a lower IRR than what we're expecting from the credit opportunity. The equity opportunity would increase our leverage, which is something we're trying to get away from in this case here. And we like the sponsor on the credit opportunity, so that's what we're recommending and not recommending the equity. There you go, Lauren.
Thank you. So these slides look very similar to what we showed before, and these are just our quarterly snapshots, post recommendations that Arturo and Joe just talked about. So on the right-hand side, you can see that these projections, again, assume our base case, a 10% cumulative decline in asset value through the first quarter of 2024. It assumes that we sell the residential and the retail assets, which provides the fund with some cash inflow. We assume that we invest in the credit opportunity, and again, this cash inflow helps us to meet some of our upcoming debt maturities. Again, the primary thing that we were concerned about in running these analyses was, what does this do to our fund leverage, and primarily does it stay below the 55%, and what does it do to our liquidity position? As you can see here, leverage still creeps up to around 51.5%, but we still feel pretty comfortable, again, against our mandated 55, and our liquidity position has increased materially compared to the pre-recommendation scenario. And most importantly, in a sensitized downside scenario, again, we really wanted to make sure that we were under the 55% mandated leverage, because this is, again, what we view as a downside scenario. And as you can see, after all of our recommendations, we're still below that, albeit a little close, but the fund's liquidity position is very strong in that it can address some outstanding debt under its line of credit or any other ways that it wants to deleverage. And this is just a nice comparison for you all to see on a side-by-side basis. Again, pre-recommendation and post, leverage improves marginally, from 52 to 51.5%. But again, the primary improvement here is the fund's liquidity position, particularly as it relates to a percentage of the fund's total NAV. And again, in the downside case, our primary concern here was that the fund stayed below its 55% mandated leverage ratio, which we have successfully done, again, assuming a cumulative 15% write-down in asset values, while the fund still maintains a very strong liquidity position. And just to quickly kind of go over how we got to this liquidity position of the fund, again, based off of our recommendations, this is a quarterly snapshot. So as you can see here, we're assuming that we pay out 2.5% equity redemptions in the fourth quarter and second quarter of 2024. We also see that we handle our upcoming debt maturities in the first quarter of 2024 with asset sale proceeds and debt refinance proceeds. And again, that helped us improve our cash balance at the beginning of the second quarter of 2024, where we felt comfortable enough to make the credit investment, which you can see at the end of the second quarter of 2024. And on the right-hand side is just a summation of, again, the fund's total cash sources and uses over the next 4 quarters through year end of 2024. And so with that, I'm going to pass it off to Dan to give us a little wrap-up.
So this is an overview of how our sector allocation has changed, sort of pre and post recommendation. You can see there's not huge changes to the percentages, but they have moved a little bit and are in line with the strategy in the short term that we outlined earlier in the presentation. You can also see on the portfolio metrics, this is assuming our base case write-down of 10%, sort of cumulative. You can see our GAV has gone down with the redemptions and the write-downs both factored in. The NAV has come down. The liquidity has come down, but is still fairly healthy at 265 million. And the leverage, although it's gone up considerably, we feel we're at a pretty good place in terms of the overall leverage of the fund. And as I said, with the sensitized case, we're still below the 55% rates. The redemptions, that represents the 2 full payouts of the 2.5% in the two periods in question, and the write-down is shown there as well. Just to touch back on the recessionary indicators, so obviously we're aware 15% write-down we think is a fairly downside case, but things could look worse. We could be underestimating this. And so we've given some thought to what strategic actions we would recommend in the case that the market turns more than we're anticipating. So obviously the risk here is that the low growth reduces the rents will reduce the property prices, and those values going down will increase, particularly our leverage, as a result. So we recommended holding the residential early on. If we did start to see more of this materializing, these recessionary risks, we would start to look at maybe holding tight with some of that residential in the hope that it can serve as some sort of hedge against those conditions. We'd also then, in terms of liquidity, the first place we'd look is our storage asset. We have this storage asset which we know is there's a lot of investor demand for. We also know that its returns are typically, from our market research, typically correlated with the markets. We may expect its performance to dip. And it's got no debt on it. So it'd be a good injection of liquidity if that was what we needed. Perhaps in the more likely scenario that it's the leverage that's under pressure, this is where we'd come back and look at the office. We like the office portfolio. We know it's not trendy at the moment to like office, but this is a good asset, we feel. It has a really long-term, very credible tenant with very long-term lease. It has 6-year financing at a fixed rate, which happened some time ago. So we know we've got sort of good terms on that. And if we were to sell it, we'd be selling it on a very high cap rate. Somebody would be getting, we feel, a very good deal. And so we would like, if we can, to hold on to this. But if things turned enough where obviously our leverage became an issue, that is where we would have to reassess this position. And if we did do that at this point, the leverage on the office portfolio would be very high. Obviously, we made the extra effort to break down the 15% write-down, and obviously that made the office performance even worse. We are aware of that, but we feel that, if we got to this stage, this is when we'd look at it. Sorry. Where's this? Oh, there it is. So just a quick overview. We looked at the recessionary indicators, decreased property prices, and the tightened credit market. Our focus is still long-term value preservation and maintaining our liquidity obligations. And we prefer the credit opportunity over the equity. And we've identified 2 specific dispositions that we would like to go ahead with, we'd recommend, and 2 others that we'd look at in a situation where we had difficulty with liquidity or with leverage, should the recessionary indicators materialize. Thank you very much, and we'll invite any questions.